All right, we are live. We're live on all the socials, live in person, and let's get started here. Hello, Smart Money Tree podcast listeners. Welcome to the show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hagerin. Hey, Doug.
Just before we got on here, Kirk said, I'm going to talk for like 5 to 10 minutes, and then you jump on. And then what does he do? Fit 5 seconds in, he's making me talk. No, good to see you. Good to see you, Kirk. Just playing with you. Happy Friday to you and everybody listening. So
Yeah, little does Doug know I was going to talk for 20 minutes, and I was just trying to be nice.
I hope so. Hey, man, I'm fine doing other little stuff in the background here. You go right ahead. I can't say anybody listening feels the same, but I'm fine with it.
Yeah, we're all good. We're all good. Well, all right, so we'll get started. We actually got a lot to talk about this week. I know Doug's putting up a bunch of charts we're gonna talk about this week. But one thing I did want to talk about is we've had obviously a lot of increased volatility in the last few weeks, and I want to explain it so that people understand what happened, why, and I'm not even going to get into the specifics of it. And for those of you longtime listeners know that the specifics of it don't matter because we don't truly know why things happen in the stock market. There are correlations and causations. Correlations are, hey, the Fed said something and the stock market reacted. That's a correlation. It's not necessarily a causation. Now, I'm going to explain a concept that's kind of like 2 or 3 levels deep. So hopefully you've had your coffee this morning. But think about it this way, okay? The Fed makes a comment, and then the market reacts. Well, the market reacts because basically prior to that Fed comment, right, the Fed speaks. We know they're going to speak. The market builds in expectations leading up to that speaking engagement. So one side of the market thinks the Fed's going to say this. Another side says the Fed's going to say that. And they figure out a price beforehand, and it's priced in based on all of the market participants pricing in what the Fed's going to say. Now, the Fed might say something completely out of character and surprise everybody. So what do you think happens when the Fed says or does something that surprises everybody? Well, here's what happens. The market is not expecting it. So if the market's not expecting it, it's not priced in, right? So let's take an example. The market is pricing in that aliens are not going to land and take over and kill everybody. That is not priced in. It's probably not going to happen. But if it did, the markets would go haywire and price that in accordingly once the information is out there. But the time from point A from before and time from point A after are 2 different time frames. The difference between the two is where volatility is created. So, for example, if the Fed says we're going to start raising rates next year and we're going to raise it by 5%, the market is not expecting that. The market is expecting that they're going to lower rates. So if the Fed says, hey, we're going to raise rates next year, the market is not pricing that in, which means that the market is not priced correctly. So everyone starts buying and selling in their portfolios to reprice based on their expectations. And that final price is what everyone thinks is going to happen. So volatility is the difference between expectations and reality. When something is low volatility, it means that everyone kind of is status quo, and we all are sitting here fat, dumb, and happy with our opinions, and we have no inclination that things are going to change. Now we go into a period where we have an election, right? Which I don't think it's going to change much economically, but I think that it'll be interesting to see how it plays out, and I'll leave it at that. But if you look at the upcoming election, people don't know whether Trump or Kamala are going to win. People don't know. And so because of that, there's a little bit of volatility that's going to exist because people don't know. Now, people generally know what to expect from Trump. We had 4 years of him. He's been talking a lot since then. We kind of know where he stands on stuff. Not a lot of, I don't know what's going to happen with Trump built into the market. Now, if you're a Democrat or a liberal and you're afraid of Trump, you think he's going to destroy the world, then you might be afraid. But if you look back at his 4 years of being president, he didn't destroy the world. He had 4 years to do it. He had no indication of doing anything that people said he's going to do, right? And so you have to look at history and say, could he do it? Absolutely. He could do a lot of crazy things, but he didn't when he was president, other than his talk. His talk was crazy and people didn't like the talk. But in terms of actions, he didn't do a lot of crazy actions. So do you think he's going to have a high probability of crazy actions if he gets elected? In my opinion, probably not. What you don't know what he's going to do. That's part of his quote unquote charm, is his unpredictability. But I think there's an element to this where I'm not concerned about him doing something totally crazy. I think that's the media kind of tilting people. Now, Kamala, I don't know what to expect from her. And now, if Biden was running again, I do know what to expect, and I don't have a lot of crazy thoughts in my head of what he would do. I generally know what he's going to do. It's going to be more of the same, right? It could be he could do something crazy. I mean, the guy's obviously his mental facilities are not there. He could do something crazy, but I suspect the probability is low that he would do something crazy, right? Just because we've seen it before. Now, Kamala, she's been a part of Biden's, ticket, if you will. I don't generally know what she stands for because she's changing her opinions right now, trying to get her base riled up. So I actually don't know. Am I afraid? Not really. I mean, I have my opinions about her, but I'm not afraid. I don't think she's going to destroy the world. I do think there's problems, just like in any candidate, but I don't think she's going to destroy the world. So am I afraid of that? No, I'm not. Do I think that she'll have some issue, lean in some issues over the others? Yes, some issues will be tilted in one direction versus the other. So I might want to change my portfolio based on whether Trump or Kamala wins, right? And because the outcomes of the economy might be very different. So I'm making a guess. Who's going to win? Well, what really happens is people make their guesses, right? One side says Trump's going to win and they make their bets. Another side says Kamala's going to win, they make their bets. And whoever's wrong afterwards, they're going to shuffle their portfolio around to realign with the other person who is right. That realignment is volatility. Now, what we saw 2 weeks ago was volatility. I don't know why it was that bad, frankly. It shouldn't have been. There wasn't any expectation. And the Fed alluded to the fact that they're going to lower rates. And the job numbers came out and surprised to the downside. Okay. I mean, that's not good. And that's a reason. But there was a lot of volatility, especially in Japan, in large part because of the carry trade, which we didn't talk about, which I do want to talk about. But the understanding is volatility is an important part of the markets. We have had very low volatility for quite some time, and that makes people complacent, hence low volatility. Complacency and volatility are not the same thing, but they're very, very, very closely aligned. So when you see high volatility, it means that people are not complacent, they're on edge. When you see very low volatility, then people are complacent. And the volatility is typically measured by the VIX. I won't get into how that's calculated, but it's complicated. But basically, it's measuring volatility. So understand how that plays in is largely based on what people's expectations are of the future and what they really are. So if the Fed came out on Monday and said, we're going to raise rates 1%, the market would have a fit and would probably drop 20% because no one is expecting that. Now, Doug is going to talk about what they are expecting because I'll share this because I thought it was hilarious. If the listeners remember, those of you who are longtime listeners who were listening last year, remember what Doug and I talked about in the show is that we're going to have 0 or maybe 1 rate cut this year. Now, that was not the consensus. The consensus was we're going to have somewhere between 7 and 12 rate cuts in 2024. How many do we have, Doug, so far? 0?
Yeah, I was just saying, is it
Huh.
even a real number? I don't think we can multiply by it.
Yeah, it's 0. They've had 0 rate cuts this year, which no one on Wall Street was predicting. No one.
A little mind-boggling, to say the least, to those of us that are on this, but we were crying that a year ago.
It was, yeah. I mean, it was so one-sided. It was laughable. No one I knew thought that it was even remotely possible. But Wall Street and the collective intelligence of all investors agreed that there's going to be somewhere between 7 and 12 rate cuts this year. Everyone thought there'd be a recession, which hasn't happened. They thought we have tons of rate cuts, which hasn't happened. Makes you wonder if you should trust Wall Street, which is why a lot of the things in this podcast we talk about how you need to think outside of Wall Street. And I'm not saying Wall Street did this deliberately. I just think they were very, very wrong, which does happen. And it's a collective intelligence that is collectively wrong, right? It's groupthink, right? If you get there's a famous cartoon. I have this book of all these old Wall Street cartoons, and they were like from way, way, way back, and like I forget, it was like the 20s, 30s, 40s, I don't know, but it was a long time ago. And they have some great cartoons, and one of them was it shows a group of people cascading from left to right, and then it has a number and has a picture below it of people cascading left to right. And on the first one, it shows like um, it says something like some guys like I forget the exact phrase, but something like um, uh, I don't want to be sold, or there's some phrase that doesn't mean sell, but it's like it sounds like sell. It's like, oh, that was a bell, and some guy next to him's like sell, and then two guys next to him are like sell, sell, and it's just like it's like the Finding Nemo where you got the mine, you got all the pelicans saying mine. It was
It reminds me of Sesame Street. Yep, 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 yep. Remember the aliens that would do the spelling? It'd be like,
yeah.
see, yeah.
Yeah, so they were like sell, sell, and then everyone else is like sell, sell, and then it gets in this, and by the right, it shows everyone's crazy, um, and and then you see the next one below it, and there's a guy there next to this big crowd of crazy sellers, and this guy's like, I'm done with this, bye, and then the guy next to him was like, buy, 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 and then it goes on to this crazy thing. That's Wall Street. That's how Wall Street operates. It's not like you have a million collective really really smart people. You usually have like a handful of smart people who are doing all the work, and everyone else just basically cribs their work. And it's not that these other people aren't smart, it's just that why not just find someone who's doing the work and just crib off them, then you don't have to do the work. That's how Wall Street works. Like there's a lot of that. And so what you need to understand about all this is that when you have these big sell-offs like we had 2 weeks ago, it basically starts because people are misaligned, and then that caused the market to drop, and then more people are like, "All right, this is getting too much." Because what happened in July is people were riding the horse. They were like, "Hey, this is good. It's easy. We're just going to keep riding it," and then all of a sudden it goes down a little bit, and people are like, "Ooh, hold on, this is uncomfortable. I'm going to get out. I knew the train was going. It was going a little bit too long, and I rode it. I'm going to get off." Then everyone does that, and then Japan had a carry trade problem, and then everyone else sold, and then it dropped. Now it's back. The point being is that volatility is because either people were staying a little too long in the game of musical chairs and didn't realize that the game was over, or there were people who were misaligned and decided they need to realign their portfolio. Whatever it is, it caused volatility. We don't know specifically why. We can guess, but we don't truly know because it's a market of millions of people making decisions. So it's more of the cartoon thing that I was sharing where people are following other people. So Doug, maybe you want to, what are some of your thoughts with all this? I mean, I know you've seen this a lot in your experience. Doug, you're not audible. Can't hear you.
Ah, there we are. How's that? Yeah.
There we go.
Yeah. So from a thought standpoint, I think I'm really kind of teeing off on what you mentioned with regards to the impact of like these Wall Street predictions and the impact of all of what that really means and how erroneous it is in so many different occasions and how that makes it really, really difficult for you to really be able to get any kind of a clarity as to what to predict over what to think and what to do over the next, 6 to 12 months, because all of these individuals, all of them Every one of them. Nobody thought there was going to be zero rate cuts. And yet here we are. There have been zero rate cuts. The only one that was really saying there was going to be zero rate cuts was Jerome Powell once again. Right? I mean, we've been saying this for a year and a half that the Fed, and I'm not saying I'm endorsing and I like it. We kind of talked about this last week. This is not an endorsement of the Fed whatsoever. But at least in this regard, he has been consistently, for the most part, there was a little bit of capitulation and wavering there that, you and I kind of, got into a little bit of an eyebrow raise because, here's a guy that wants to be Volcker, and he was starting to kind of show some signs that were going to possibly indicate that he was not going to stay the course. Well, for the most part, he has. But here's the thing. We are back to those predictions, and we've been hearing rate cuts. There was, 12, 15 rate cuts expected. We got zero. Now we're going ahead and we're going to be looking at more rate cuts predicted going into the future. There's still, everybody is clamoring for rate cuts. I will tell you that there's definitely more volatility there that's happened. Most of this, again, was triggered because we've talked about this before. Wall Street doesn't like things that they are not aware of, right? You talked about Trump. And that's something, again, we've talked about, we can get into when we talk about the politics. I would save this for a later conversation today or maybe next time. But, again, he has things that he's going, that are going to happen, from prediction of taxes and tax policy and political policy. And Harris has different things that she wants to do with regards to tax policy and political and geopolitical policy. And guess what? When it comes down to it, we do kind of have an idea of how Trump's going to handle that. We don't have an idea of how she's going to handle it, even though people would say, hey, Biden, there's a lot of memes going around right now. Like, well, says the, well, I'm going to change all this, says the party that's already in power. Well, she's the VP. She's not in power, right? I mean, if anyone would understand politics, the VP has no power whatsoever and probably has very little to do with the policy. They're there to basically, be there in the event that the president passes away or to cast that extra deciding vote in the Senate. I mean, it really is, from a political scale, a very weak position. So we don't know what Harris is going to do if she comes to power. And I think that's definitely something that would lead to more volatility in the markets. If we get closer and closer and it looks like she's going to be elected, that uncertainty has historically led to more concern within the markets. They like what they know. Now, it's been 4 years since Trump. That means that, he's a little bit older. There's certainly been talk about whether or not he's also got, early dementia. I don't know. I'm not a doctor. There's just people have said they think that it's possible there too. I mean, he's almost 80, if not 80. I forget his exact age. It happens. So is there going to be uncertainty there too with regards to what is he now as opposed to 4 years ago? Absolutely. I also want to get into kind of what now we're seeing from Bank of America Global Fund Manager survey that just came out. This is 189 managers. They might have a little bit of insight as to what's going on because in combined, they manage 508 billion assets under management. That is a B there, Kirk. That's quite a bit of leverage and insight into what's going on in the market. And right now, what they are starting to say from their own surveys is they're getting pessimistic. Okay, worried about a recession. Once again, they're expecting at least 4 rate cuts. They have been rotating out of stocks into bonds. At least they were. Now, again, we have seen the markets come back a little bit here. But there is, certainly, there's certainly, the market coming back doesn't necessarily mean that there's been rotation. They are starting to believe in more agreement that the U.S. recession overtakes the geopolitical conflict as the number one tail risk. Again, before it was geopolitical. We've been dealing with the Ukraine-Russian conflict. Yes, there's talk about what's going on between Palestine and Lebanon and Israel and Iran, but right now recession is the bigger worry to them. And U.S. recession is now 39% up from 18% in July. So a big jump there as the number one tail risk. Other tail risks that are there are higher inflation, systematic credit event, an AI bubble, and U.S. election sweep still being really heavy. The reality is that where we were in July of 2024, geopolitical was number one, higher inflation was number two, and and U.S. recession was number three. It has jumped to number one with geopolitical number two and higher inflation number three. So even though we've seen inflation go down, it's still one of those concerns that is still in the back of the minds of these managers. And if we look at obviously where that's trending compared to June of 2024, inflation has certainly declined significantly. Although another one that has kind of spiked a little bit, systematic credit event was big in June, fell in July, back in August. So I think there's a little bit more worries going on there with what might happen with credit, and we've got some more data on that too. A lot of them believe that monetary policy is a real concern. So we're starting to see that at least going back to 2000, as far as this goes on the survey, the four biggest global policy restriction concerns were April of 2001, October of 2008, March of 2020, and August of 2024. And now the August of 2024 is kind of right there, close to where it was in 2001. So 55% of FMS investors, they believe that global monetary policy is too restrictive. That's the most since 2008. So again, that's something that's driving some concerns. 93% of global fund managers are starting to predict that they think short rates will be lower in a year. Again, that comes back to in line with the inflation, with the belief that inflation is down. That's the highest percentage in 2023, in 23 years since they've been asking that question. And that is higher than in the financial crisis. And that is higher than 2020. So, this is what we call soft landing, economic conviction. Basically, if they believe, 93% believe that short-term rates to be lower in the next 12 months, they are believing that they're heavily waiting that the soft landing is going to occur. They're also, let's get back to those rates, 60% of global fund managers expect at least 4 Fed rate cuts in the next 12 months. So we're back to that. 30. So if we take a look at core optimism of a soft landing unchanged, but a greater degree of Fed policy easing in the 12 months required to achieve this outcome, 60% of FMS investors expect 4 more rate cuts from the Fed. Okay. So 4 cuts, 31, we're looking at August 2024, 31, what's the most likely move they're predicting? Well, 31% say 4 rate cuts, 29% more than 4 rate cuts, 21% says 3, but that's a drop as some have shifted to 4. You still have a number of them that still think 2 or 1, but those are declining. So once again, we're starting to see that expedited prediction that we're going to have significant rate cuts with 59%, again, expecting lower long-term rate cuts over the next year. And lastly, just to kind of talk about the movement that was happening in the markets, there was a significant August rotation into bonds, which is not unusual when you're dealing with concerns about the economy, but where money moved out of. So number one movement, and this was, I'm trying to remember if I got a date on it, well, it was August, so I don't know when they did this, but there was, equities, Japan, Eurozone, materials, utilities, and telecom were the biggest areas that money moved out of, followed by tech, banks, discretionary, commodities, energy, and others. And where did they move? Starting at the lowest movement they moved into industrials, then REITs. So in real estate got some movement, healthcare. The second largest movement was cash, and the largest movement by far was bonds. So definitely, that of course is a bearish mindset. But again, that was August, and that was when the volatility hit. If they move past the fears of Japan, and some people are moving past that, there's others that are saying it has not yet hit, well, then we may see a rotation back to stocks to drive it up if those fears alleviate. And that's the thing I think, Kirk, is really important to think about, is these opinions They shift very, very rapidly. And and a lot of times, even these wealth managers, they're human, right? So they will follow trends. They will sometimes be late to the game on their bearishness. Going back to Japan, most people came out and said we didn't see that coming. It was a surprise to a lot of them. And then they reacted. And now what could happen is if they feel that trade, and again, these managers are paid to make money. So if the market's going up and they're sitting in bonds and cash, that would be bad for their performance. So if this continues to go on a run, and and again, we don't know because 2007 the market tanked, came back, market tanked in 2008. Not predicting that's going to happen, but if we start to see a run again in a complacency like you were talking about back into the markets and stocks start running, then you could all of a sudden potentially see them reshift their allocation rotation in September, maybe even still in August, back from bonds and cash to equities. And all of a sudden everything's good again, right? So a lot of times these things tend to be reactive. By the way, Trump's 78 years old. Kirk, correct me on that. I didn't have that right in front of me. I knew he was close to 80, but I couldn't remember the exact age. So that's kind of what was happening over the last week or so with that volatility, but also some of the sentiment that we're seeing. But again, as we said, sitting here a year ago, rate cuts, they're inevitable, right, Kirk?
Yeah, they're going to happen, just like everyone says. I mean, it's what the important takeaway is. Not that we were right and they were wrong, although I'll repeat it again: we were right and they were wrong. Just letting you know, just saying. No, but in all seriousness, it to us it was so obvious. We're sitting here, I mean, like, what are these cuckoos thinking? Now, I think the other day I read a stat that said seven rate cuts was kind of the average expectations. This one says four. I think four is actually probably more reasonable. I don't. I'm not predicting that we're going to have zero for the next year. That's actually not my prediction. I would say, I stand by my thesis that we will have 0 to 1 this year. I don't know if we'll have, and my biggest caveat with the 0 to 1 was my thinking was we'd have zero because of the election. That the Fed doesn't want to bait the election by doing a cut right before it. I know that happened with I think it was Bush or one of the two that I think there was a rate hike before an election with Bush, and he got pissed at the Fed because they changed the election. They're really sensitive about that. So I'm suspecting that they're probably not going to before the election because it is kind of a political topic. Could I see them doing after? Yeah. I mean, I could definitely see that. But then it's a question of, is the data support that? It appears, based on what they're saying, that the data might support doing one in November. I'm not 100% sure that's going to happen. I still think it might be zero this year, but I'm like 50-50. So it's possible we have one. Next year, I'm not there yet, but I could see four if the economic data starts to turn south. I'm not there yet either. Because right now it looks like either the stock market is asleep, which is very possible. The bond market seems to be awake, but also they're awake because the Fed says, "Hey, we're probably going to lower rates," which is why they woke up. So it's kind of hard to say whether people are actually awake right now. But this also dips into my theme of things are very different. And I talked about the theme last week, and I'm going to do it over the next few weeks in little bits and spurts because it's kind of a big thing, and I want to be really crystal clear about it. I have not changed my thinking that times are different. I think we are definitely in different times. I don't think they're based on inflation anymore. I did a lot of research and talked to a lot of people and realized that technically my thesis is correct if we were in different times. But because of the fact that the Fed is printing so much money, that it basically mutes all of the normal responses that the economy would have. So you want to know why we don't have high interest rates when the Fed is basically printing money like it's going out of style? Do you know why we don't have high inflation when we basically double the money supply in a short period of time? Now, people might say, well, we did have high inflation. Yeah, because the supply chain was broken. It's not because we had high inflation. It's because you couldn't get the goods. It's like, yeah, I want to build a house. Well, I can't get wood. Okay, well, I'm going to pay the lumber mill more so I can get the wood. Okay, well, now I got to pay them more, and I got to. So the whole thing expands. And you saw lumber prices, which I think Doug was nice enough to share with me. Lumber prices went through the roof. They went from like 200 up to like $1,400 a unit. Like that's crazy, right? And I can't find them. They're here somewhere. But anyway, but that's crazy. But now they're back down. They're back down like 80% from the peak because it was more of a supply chain problem than it was an inflation problem. And that's not generally how inflation works. You don't go up 100, 200, 14, 300% in an item uh, if you have 10% inflation. It goes up 10%. It doesn't go up 100%. The spike was in large due because of the supply chain. And I'll keep going back to that over and over again. It doesn't mean we didn't have inflation. I know we had inflation. That's not my point. My point is that the effects of inflation are muted because of the large amount of money, and that people don't realize that because the inflation is largely contained. Now, the real inflation that everyone's experiencing is real. I'm not saying it's not. I want to be really clear because I know someone's going to misinterpret this. The inflation that everyone's feeling is real. It is not reflected in the CPI. The CPI has been largely seen as inaccurate by many, many, many people, including myself. And so if you look at inflation that the normal person has, might be like, whatever, like 100% over the last 4 or 5 years. But the CPI says 26. Well, I know I've paying double what my grocery bill was paying before. It's not 26% higher, it's double. I know that, my car is not, 26% higher, it's like 50, right? So all of these factors, and you could say, yeah, the aggregate, whatever, I get all that. But the point is the average American is spending a lot more than they were before. So we have inflation. You can't keep up with that with a bond, right? And we get into this later. See, so I'm not saying that everybody should go into tech and crypto. I'm not saying that. I want to be really crystal clear. What I'm saying is the thesis is if you have to keep up with this silent inflation, what is going to outpace it over long periods of time? That's what you have to consider. Short term, I could see tech, crypto getting crushed. I'm not saying you should get into it now. I'm just saying you could get crushed. What I'm saying is that if you're thinking about longer term inflation, you have to realize that the old way of viewing inflation may not work anymore. It may not be just put your money in the S&P and you'll be fine. That might keep pace with inflation, the silent inflation. It may not outpace it, which means how do you outpace inflation? There's really only a handful of things that may do that. But that's the challenge, is my point. The challenge is to try to outpace the silent inflation. Now, I want to talk about something really quick and give it back to Doug because we skipped over it next week and I want to make sure we hit it. Carry trade. I got a lot of emails on this in the last week about the carry trade. We mentioned it and we didn't touch on it. All right, here's the essence of the carry trade. It is a complex topic. I'm going to keep it really simple. So there's a thing called Forex, basically foreign currency. I forget what Forex stands for, but basically Forex is like currency trading. So it would be like selling the US dollar and buying the euro, right? Or buying the Australian dollar and selling the Canadian dollar, right? It's what we call kind of a pairs trade. It's you're selling one thing and you're buying another. Now, the goal of this is that you think things are going to go in a certain direction and go against the other direction. So you're making a bet. You might say, well, that sounds risky. Okay, well, let me explain it in more normal terms. If you want to buy gold, let's say you think gold's going up. You own cash, you own US dollars, and you think gold's going up. What do? You buy gold with your cash, right? Simple. Okay, but what are you actually doing? When you're buying gold with your cash, you're actually selling cash. So it means that you have a negative opinion on cash in comparison to gold. You think gold's going up. Well, gold is priced in dollars. It's not priced in Martian dollars. It's US dollars, right? So you own US dollars, you're buying gold. It means you're selling dollars and buying gold, right? That's the pairs trade you're doing, right? Because you're getting rid of your dollars and you're exchanging them for gold. Now, let's say you think gold's going down. You sell your gold and you buy dollars, which means you're buying dollars, shorting gold, right? Is you're doing one versus the other. Everything you do is a pairs trade. You don't see it because all you have is dollars. But if you lived in Europe in the old days where everybody had different currencies, you knew all about this and you were good at it. You're like, oh, we're buying this and selling this. Hey, we're going to Switzerland this summer. Let's buy some Swiss francs. We'll sell our German marks. So all that stuff is always going on in the world. Now, most people don't play in the currency markets. It's not a common thing to do. It is a lot of people speculate in them because you can get a huge amount of leverage. You used to be able to get like 100 to 1 leverage, which is crazy. So if something goes up $1, you make $100. Of course, if it goes down $1, you lose $100. So leverage is crazy, and a lot of people used to do it, and they've curtailed that a little bit. Point being is a lot of people play in those markets because they're doing that crazy stuff. Now, institutions are huge. So if you think of the biggest markets in the world, you think the stock market's big? It's not. The bond market dwarfs the stock market, but the currency markets dwarf the bond market. These are where institutions, countries, central banks are trading in currencies. It is a huge market with big fish playing in it. And you are not going to move that market. The market is just too big. So the carry trade, what it effectively is you think that one currency is going to do well and another is not. So let's say you think that the dollar is going to outperform the yen. So you buy the dollar and you short the yen. Actually, let me use a different example because you own dollars, it gets confusing. Let's say you think the euro is going to outperform the yen. So you buy the euro and you short the yen. That's a pairs trade, right? Now, what happens when you do that is those currencies pay interest. So, or we're using, let's say, short-term bonds. There's interest paid, right? If you have dollars, the interest might be 5%. If you have yen, it might be 0%. I'm not sure what it is now, but somewhere around zero. So if you're buying dollars and shorting yen, means you're selling yen to buy dollars, you're getting 5%. And because the yen doesn't cost any money, you're making 5% with that trade. It sounds like easy money. The only problem is what if the trade goes against you? So you own all these dollars that are paying you interest, but what if you shorting the yen? What if the yen goes up? Well, now you lose a lot of money, and it could be in excess of the interest you're making. Well, that's a problem. Well, if Japan has negative interest rates, like it has had for many, many years, why would you buy the yen, which is going to lose money? You don't. Everyone was shorting the yen. So they're shorting the yen, which means that you're making money. So it's like a negative plus a negative equals a positive. So the yen's, the yen's costing, let's say 1%. It's not accurate. It's like 25 basis points or something, but let's say it's 1%, just to make the numbers easy. You're shorting the yen at 1%. That means you're taking in 1%. And then you take the money that you're shorting and you're buying the euro, which is paying, let's say, 4%. So you're making 4% on the euro, you're making an additional 1% on the yen. So you're making 5% with that trade. That trade is great as long as the yen doesn't start going up. If the yen starts going up, you could lose a lot of money. So the problem with carry trades are they're easy and you can do them for long periods of time until you can't. And when you can't, it goes the wrong way, and you get this like what happened in Japan the other week, where you had this big crash in the markets. And some part of that was the carry trade. Is that central bank comes in, they're like, all right, we're gonna boost the market, or they're gonna come in and do an event. They're gonna come in and stimulate the markets. People get caught off guard. Remember we talked about earlier with volatility. People get caught off guard and they're like, oh my God, I got to get out. And everyone sells and you have this crash. So understand the carry trade is a way to make money. I wouldn't suggest anybody do it unless you're a really, really sharp global macro investor. And even then, I still wouldn't suggest you do it. It's really for big institutions that are trying to hedge positions, in currency markets globally, and they're trying to hedge risk. It's really for them. You can speculate in it if you're really good, but nowadays the markets are so screwy. I wouldn't touch it. It's just you have to be really, really good with it. Anyway, I just wanted to explain the carry trade because it's really important.
And let me add something on that risk there. Right after the carry trade fears hit, Japan reversed course and immediately and immediately, tamper down all of the risks of that carry trade. So if you're going to be trying to do carry trade, the thing you're going to have to worry about is the monetary policy, because all they have to do is a flip of a switch. They change their plan, their policy plan. You could absolutely lose everything, right? Because you're relying on you're relying on, unfortunately, decisions to be made. This is not just like supply and demand here. And that's why there's very few people in this world that successfully trade currencies.
Yeah. It's not something. It's something you see a lot in the speculative corners of the internet, where people promise you big money and hundreds of percents of return. They'll promise you that, and that could happen, and you could also lose hundreds of percent return. The problem with leverage is it can, if you're leveraged 100 to 1 and it goes against you by 1%, you're at zero. If it goes against you by 2%, you owe twice as much money as you invested. That's not a good place to be. Leverage is really dangerous, and I don't recommend it to anybody. It is one of those things where, you own a home, you're leveraging your home 80-20, you're leveraging it 5 to 1, right? That's leverage. It's really dangerous, except for the fact that you live there and it's your home. And people do it because they don't want to be homeless. So what do? They make sure they get paid. The first person who gets paid in the bill every month is the mortgage, because I don't want to have to get foreclosed on. So the leverage, albeit is a lot, it does rely on inflation. So if we don't have inflation, your home price goes down and the mortgage stays the same. That's a bad place to be. It also relies on the fact that you have prioritized that position. So mortgages have become less risky because of the fact that it's your home. But if it was a car, right? If you're just leveraging your car up, you'd be like, take the car. I don't care. I'll go get another one, right? So because you're not living in your car, or most of us aren't. You're not living in your car, so you're living in your home. It's important. So understand that leverage is really dangerous, and you shouldn't use it at all. Even the professionals who do use leverage, they do it with a lot of foresight and understanding of risk. So while they might be shorting some stock, ABC stock, they might also be going long on a stock in the same industry. So it's more of a delta neutral trade. And that way the risk is mitigated. So if the stock market crashes, they both go down. Well, they balance each other out. So they're always managing risk. More of the retail investors that do this, they screw it up. They're like, I'm just going to naked short this stock and I'm going to be right. And then if they get blown up, like, I don't know what happened. It should have went my way. Like, if you'd done a delta neutral trade, you would have been protected. But, I think people really need to understand risk better. But I did want to share that. So I know we're going to have to kind of wrap it up in 12 minutes. But what do we want to talk about, Doug? So, you sent me a lot of real estate stuff. And where do we want to go with all this? This is a lot.
Yeah. So there's a lot of juicy nuggets out there. One thing I did post, if you wanted to come back to it, the lumber prices. They have declined to their lowest level since 2020 pandemic. They're down 80% in 2 years. There is a lot of correlation of lumber as a leading indicator for the U.S. housing market, which makes sense, right? Global economic conditions, inflation, lumber is used to build structures. And again, there's two things going on here, right? And it's one of those cart before the horse kind of scenarios, or which one is the cause, which is, in the effect. Lumber dropping, is it because we are not selling homes and not building homes? Well, the builders have actually been doing fairly well. There's a lot of new build starts, and one of the few areas that people have been able to find value is in new builds, and that has helped those builders to continue. Now, they did report, by the way, I saw that for the first time that we have seen a crack in that, the U.S. home builders finally did come out in August and say they saw a surprise softening there. The other thing, though, to keep in mind is that lumber is all not only used for new build, it's also used for renovations and additions. But here's the thing. If we go back to 2020 and we go to the pricing, supply and demand, is it because lumber is not selling, or is it because lumber is now gone back to normal selling, right? Because we had such a bullwhip effect, right? And we talked about that. Hey, those who've been listening to us may have heard this one before. The bullwhip effect of we can't get lumber. We need lumber. We're trying to work. The prices are through the roof. And now, boom, we have that supply again. So have we reverted? And if you look at the lumber prices here on this chart, they haven't plummeted below historic averages, right? They're just back to historic averages. So in some degree, this may not necessarily fully be an indicator of the housing market slowdown. Now, I want to just get, since we're talking about the real estate on that, I guess I'll stay on this one for now. There's also, there was a new report that just came out that we've talked about this before, housing affordability. And Kobesi letter, this comes from the National Association of Realtors, mortgage rates of around 7% assumed. They are now saying that an income of about $190,000 or more is needed to afford a typical home in 20 markets. Now, no surprise to anybody, the top markets for cost are predominantly California, with Hawaii slotted in there at number 4 in urban Honolulu, which never is going to be inexpensive. Everything's expensive in Hawaii because they don't have anything. Everything's got to be imported. But we then get to Colorado, which is now sitting there at 1, 2, 3, 4, 5, 6, 7, about 8. And then it goes to Florida, back to Colorado, and then you've got Washington. And then right there in your neck of the woods, Boston, Cambridge, Newton, Massachusetts, New Hampshire. And then we get to Connecticut, Massachusetts, New York, again, Colorado, Florida. So there's a little bit of a pattern there, but the majority of this is on the coast and the majority of this is still on the West Coast. Now, that's not necessarily just that affordability. That's great. Look, these are that's a calculation. It's a calculation of the income you would need to be able to afford these homes at these levels based off of what it would be to manage a payment. But I'm going to go a little bit deeper here and talk about what's really going on. And we're starting to see some reports. There is, again, this came posted as a conversation that had occurred in the Dallas market, but somebody that does a lot of posting on the real estate market, especially in that area, said that they were talking to someone that was a realtor, that was one of a top 10% realtor in the Dallas area, hadn't sold anything since the second half of 2023. So there's definitely starting to see in certain markets, and we've talked about this before, significant slowdown in those transactions. Now, Florida is dealing with some different issues. Florida's got the issues of insurance spikes, making it really, really expensive. Dave Ramsey likes to say nobody's ever lost a home who had a paid off mortgage. Well, I don't know if Dave Ramsey's ever dealt with individuals who have had their insurance and their property taxes double on them. But guess what? These are costs that never go away. They're now seeing, and this was an NBC News report, that Florida condo owners that have been living there for years, this is something that people don't always think about when you're dealing with a lot of real estate that is multi-tenant, is you've got to divide up the cost of those repairs amongst all of those tenants. And a lot of these individuals these are retirees. They've moved down to Florida. They might have been in condos for years. They may have decent assets and net worth. But when you're looking at a situation now where some of these condos are now they're 50, 60, 70 years old. Here's an example here of a 53-year-old building that has deteriorating concrete. And now there's a story of a woman that had retired as a teacher and school administrator. She's going to have to go back to work to deal with a $100,000 assessment from her condo association. Yeah, so again, I don't know if she had a mortgage on this still, but these are the things that when you say, oh yeah, if I pay off my mortgage, I'm going to be completely fine on real estate. Real estate is an exceptionally expensive asset to continue to maintain and hold. Those costs never go away. Now, not everybody's got condo association assessments, but even a single family home, you are now not splitting that assessment with everybody. You've got to deal with foundation issues. I've got neighbors who are being hit with codes for having to replace their septic systems. And unfortunately, and this is something you really need to think about when you hear this canned advice out there. It's like, you should just pay off your mortgage and you'll be fine. You'll have all this extra money. There is something to be noted about, I don't know her situation, but if you have taken all of your money to try to pay things off and not maintained enough liquidity and access to capital, and you get hit with $100,000 assessment, I don't care how low or paid off that mortgage is, you may still lose the house. So I think this is, it's a really, it's a testament of what's going on in real estate. It's also a testament of just the costs of of really good financial planning, and understanding there's more to these decisions you have to make in terms of maintaining liquidity, because especially with real estate, those costs are never going to go away. I know we've got some other things that I really like to get into, but I know we're coming up against the hour and we've got a hard stop here. So again, I've got some information. I want to talk about taxes. I think in some of the proposed cuts, or what's going to happen with some expiring tax cuts in 2025. We can talk about that in one of our other conversations. More on real estate, more on some data around what's going on in the economy. But again, those of you listening, you're just going to have to come back and listen next week. So,
Yeah. Yeah, no, this is all important stuff. We'll get back into the real estate next week because there's a ton of stuff that we've seen. I know in Massachusetts, there's actually a court case that totally changed the realtor market, where it used to have these dual agencies, and I don't fully understand it. And frankly, I don't think the realtor market understands it, because I've talked to a few people, I talked to some mortgage agents, and they've said that nobody really understands the implications yet. But it was basically kind of like an antitrust lawsuit against realtors for upcharging, for basically overcharging, but also forcing people to use forcing the sellers to pay versus the buyers. I think, to me, it sounds like, was there probably an antitrust lawsuit that should have been had? Absolutely. Like, I use Zillow. Why should I go get an agent to go buy or sell a property when Zillow will do it for me? It's kind of like the whole cabbie versus Uber. Let technology have its way, but they have this thing. Anyway, I'm not going to get into it because I don't fully understand it. Nobody seems to fully understand the implications. I just know that it's an issue, and it starts tomorrow. It starts on Saturday. So those of you looking for a house, buy or sell, just be aware that that's a brand new thing. No one seems to know what's going on, but we do know that that's a thing. Anyway, Doug, why don't you kind of wrap it up here so we can take her home?
absolutely. Thank you, Kirk. So yeah, we'll wrap it up again. We don't talk about a lot of the stuff going on in the economy, but really, as those of you who've listened know, one of the biggest things I'm helping with, especially, is a lot of people in Gen X. And what are people in Gen X facing right now? And it's not just Gen X. There are some baby boomers facing this, and definitely some Gen Y starting to come on the front end of it. But Gen X is getting socked between the eyes right now on trying to figure out how to deal with these insane rising costs of college. Matter of fact, just running some numbers and software, depending on how old your kid, you might have a 3-year-old right now, and you're thinking about college, and you look out there at 3 to 5% inflation. You might be looking at a 4-year cost of $500,000. A lot of people are looking at schools right now, even in today's dollars, that they might be looking at $500,000. And if you spend $500,000 on college, and you think about opportunity cost and what that could cost you if you could keep that money, even $100,000 of it, and let that stay invested for the next 20, 25 years, you are talking easily. And again, if you've got a good wealth manager like Kirk or somebody else out there that's going to be able to at least get you 5 to 6% regularly or more, you are talking about the loss of $500,000 to over $1 million in wealth of your future. And if we've got people in condos trying to figure out how to pay $100,000 assessments, don't have enough money, wouldn't it be nice when you're in retirement to have another $500,000 to $1 million? That starts with proper college planning. Okay, college is expensive, but there are multiple ways to figure out how to get the cost down and pay for it. And if you care about having more of your wealth and giving less away to the colleges, you need to start planning now, whether your kids are 2 years old or 17 years old. Have that conversation today. If you want to learn more, mergentcollegeadvisors.com, mergentcollegeadvisors.com. You can get a hold of us through the show. You can reach out to me and be happy to talk to you, give you some information, learn about your situation, and figure out how to save you $1 million or more in your lifetime.
Great. Well, thanks for coming on, Doug. I know you do a good job with all the college families, and much appreciate that. Anyone who's getting ready to go down that path, and now is the time. It's the crazy time of year. August to November gets a little crazy in the college space, so definitely contact Doug for that. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle, or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your life like you do.